What is Forex? Because a lot of people just come into the business not really knowing what Forex is. They're saying they join Forex, which is you can't join Forex. You start to trade the foreign exchange market. So if we did, what is Forex? Oops, spell is wrong. So basically, Forex is basically currencies in different countries trading against each other. And like, for example, like you have the US dollar, correct?
Mm-hmm.
And you have the Mexican peso, right? You know how you go to Mexico, they you exchange your money.
Mm-hmm.
So foreign exchange market is nothing but those two currencies fluctuating against each other, showing the value of each other. So like, for instance, if I gave you, if you gave me $1 and I gave you a peso, based on the foreign exchange market, like the value of it, I could give you $1.50 in pesos versus, me giving you $1.25 because the market's a little lower. So it just, fluctuates against each other. So the same thing goes for, the US dollar and the euro. It's a lot of different pairs out there, but basically that's what the foreign exchange market is. It's just trading between two currencies against two countries, if that makes sense.
Yeah.
You with me?
Yeah.
And that's basically how the market just fluctuate in the matter that it does, just because one currency is going up and one currency is going down, the value of it.
Mm-hmm.
Right.
Mm-hmm.
So one thing to know about Forex, that everything is a buy or sell. I mean, even before we start going into the chart, let's like go back to like, how Forex even came to be, So and we just like thinking of like who controls the market, right? And this is goes along with how we trade, because how we trade is basically, how the markets are controlled. And if we look at Forex market participants, biggest Forex market participants, you see that the banks to the left, right side of your screen are in control of the market. So that means JP Morgan, you see all these, banks that you recognize, Bank of America, JP Morgan, Citibank, they all have, over 5% market share in the market. And you understand the market is a $7.1 trillion market a day.
Mm-hmm.
So they have, 10% of 7 trillion. That's a lot of money, bro.
Shit, yeah.
That's a lot of money. So realizing that the banks, what they do is that they take our money and they start to trade our money in the market to make more money, and then only give us 1% on our money, with the interest rate, or not with the interest, with the interest rate, for the year that we get, we get 1% interest on our money, just from sitting in the bank, but they're gaining, 10% a day from all using our money.
Doing the shit that we could be doing.
So, that is kind of crazy, once we know that, the banks are the ones controlling the market, that's how we want to trade. So look, hold on.
Hey, I wanted to ask you something about that little chart on the side over there that had the percentages beside the banks.
Hold
Is
on.
that
Go back to that one right here.
Yeah, like over there where it said market share percentage.
Mm-hmm.
That's how much of the market each one of them
Contains, like, capital wise.
Okay.
Like, I don't know how much, 5% of 7 trillion is, but
So
it's still a lot of money. You know what I'm saying? It's $7 trillion, like,
yeah.
and that's a day. That's a day. You're not talking about like, over a month or two. We're talking about a day. This is what they do. So, understanding that, they have a big share in the market, they can manipulate the market. So
Mm-hmm.
you see it right here. JP Morgan Chase admits to U.S. bank manipulation, agrees to pay $920 million. $920 million, bro. That's a lot of money. But you know what? They're making more money by manipulating the markets. So, they're fine with paying this $920 million fine because they're making a lot more than that
Mm-hmm.
when they're trading. So they can manipulate the market. Like, for instance, they can manipulate the market here, this long ass line. That's them manipulating the market, taking everybody's money. They probably made like $1 trillion, so $3 trillion. So who cares if they have to pay, 920 million? That's nothing to them. You know what I'm saying? They making billions. They making 6 billion, 7 billion. So you making 7 billion. You got to pay 1 billion taxes or 1 billion in fines. You still on top.
Mm-hmm.
You know what I'm saying? You still on top. And understanding that this right here, that's my mentor in the corner. But
Okay.
we were talking about this yesterday, right? And understanding that this is how the world works, bro. You got the government, right, under the bottom. Matter of fact, you got the people, the planet, and all living things on the bottom. Then
Mm-hmm.
over that, you have the government, and over that, you have the big corporations, right? Then you have the big banks over that. Then you got the national banks over that, which are, there's only three of them in the world, right? So the national banks are in control of, Citibank, Bank of America, all the Wells Fargo, the ones that we see, on a daily basis, around, in the streets, but you got the national, central banks as well, and those are a whole nother different, different banks that control the smaller banks. Kind of crazy, but you got banks paying banks,
Mm-hmm.
then you got the international central banks, which is the World Bank. Then you have over top of that the Bank International, which is control over everything in the whole world. Then over top of that, you have the elite people that's actually in control of that. You
Yeah.
know what I'm
Yeah.
saying? Because somebody had to make it up. So the ones that's in control of the market basically control everything that comes down further down the line, bro. If that
Yeah.
makes sense, because they're basically feeding everything else.
Yeah.
So, understanding that the financial elite at the top are the ones that's control the government for real, to be honest, because they the ones that's feeding them. They're the ones that's putting these laws into place. They're the ones that's like, manipulating the news, like, to make it seem like this and seem like that, when it's in reality it's all just to control the market and control us, because the only way they control us is with money, and they
Mm-hmm.
understand that. So that's why they limit us to, how much money we can make, until we get into the markets and we learn that we can make, a lot of money in the markets. But that's not what they teach us. It's not, they don't want us to know this. You know what I'm saying? This is information that was held against us because they knew how powerful it would be if we got a hold of this and we knew the truth. You know what I'm saying?
Yeah. Yeah.
So understanding that, the banks manipulate the markets, this is how we trade. We trade smart money, and it's a concept, right? You have different concepts of trading, but we trade smart money. And smart money is a lot different from other retail traders that's out there, because retail traders, you know, they don't trade with the banks, so they don't get the big movements that we get. But you know, and they're not also successful. Like, look at this right here. How many Forex traders fail. Most Forex traders fail. 70, 80 to 90% of Forex traders lose their money. And you know why? You know why? And this is the crazy part about it, because if you realize that, you know, the information that they give us, because a lot of people want to, all right, bet, you know, I want to learn Forex cheat sheet. So let's just type in Forex cheat sheet, you know, in Google. And this is what we get. You know, we just get a whole bunch of patterns. We get a whole bunch of confusions. Like, it's kind of overwhelming in a sense, right?
Uh-huh.
If you're just looking at all these patterns, like, you got to memorize all this. Like, bro, what?
And
Like,
you don't even know what you're looking at.
This is crazy. And this is free information, right? This is free information off the internet. So this just gives you to say, like, bro, you got to be careful, you know, what you're looking at on the internet, because what you're looking at the internet is controlled information anyway.
Yeah.
You know what I'm saying? So it realizing that the information that's on the internet is controlled, you know, makes you see in a different light, that, you know, you can't really trust everything. You know what I'm saying?
That's majority of the reason why I'm taking this approach going with you, because I could research stuff myself, but, you know, with that, I could be finding false information. It'd be hard for me to build my own technique and things like that, picking up false shit along with shit that work, you know?
Yeah, because
Faulty ass technique.
This doesn't work. And this is why most Forex traders fail, because they trade these patterns. Because this is what they learn, you know, from the internet. You know, we're in a place now in society where you can go on the internet and learn anything off of YouTube, you know, off of Google, whatever the case may be. You can go on that Pinterest, you go on all these websites, and you can learn, you know, you can learn simple things out there. But it's kind of different when you're looking at the technique of trading, because there's so many different techniques of trading. You know what I'm saying? And, you know, I'm the guy who really, you know, showed me the basis of trading, traded retail patterns like these. You know what I'm saying? And I didn't really pick it up, but, you know, good thing I didn't really pick it up, because I understand that these are retail patterns. You know, we're going to lose money, versus trading smart money. And smart money is knowing where the banks get into the market, because the banks are in control of the market. So that's why we trade with the banks.
Mm-hmm.
That makes sense?
Yeah, I think that's something I paid attention to on your thing one day. I think I heard you saying something about that and shit.
Yeah, because that's like the most important key to it all. If we understanding that the banks are the ones manipulating the markets, the banks are the ones are in control of the market, that means that we can ride the waves with the banks. You don't have to just try to learn retail patterns, support and resistance lines. You know, we don't have to do that, because we understand the banks are controlled. So if you know where the banks are, you understand that you can ride the wave with the banks. So this is how we usually identify where the banks are. Right here. So before we even get to here, for real, I just want to go over, you know, how to read a chart for real.
Yeah, I was just ready to tell you that, bro, because my brain is used to seeing what you showing me. Every time I see that, all I think about is binary options. So
no, this is
I need to
completely
understand
different
the difference.
situation.
Okay, show me the difference, because
So
that looks like a
the
candle to
market
me.
the market only moves up, down, and sideways. And to give you an example, what up, down, and sideways means. We're not going to stay on this chart. We're just going to show you direction. That's down, of course, right?
Mm-hmm.
This is up.
Hey, look, I want to tell you something, right? Just for the record, right? Some things that you showing me, I may know a little bit, but I'm gonna act like I don't, because I want to be taught
Fresh new
properly.
start, brother.
Yeah, bet.
Fresh new start. So
All right,
it don't even matter if you know everything. I'm just gonna go over everything anyway.
there we
And you
go.
can see how that is sideways motion. So you see the up, down, and sideways motion, right? These are
Yeah.
sideways. This is sideways motion, right?
Mm-hmm.
This is upwards motion, right?
Mm-hmm.
And this is downwards motion. So understand that the market does nothing but move up, down, and sideways. You're able to identify which directional bias the market is going. If it's going up, down, or sideways. And you can clearly see if it's trading sideways like it is, then it's trading sideways. If it's going up, then it's going up. If it's going down, then it's going down. It's kind of self-explanatory. You can understand directions. You can understand, the market's moving down here. You know what I'm saying? That's clear. Market's moving down. Created this range, moved sideways, then it moved up. You know what I'm saying? Once it moved up, create a little range in here, then it started moving down. You know what I'm saying? So sideways, up and down.
I got you.
Right
Hey,
now, we're in another sideways motion.
yeah.
You know what I'm saying? So understanding that the market moves up, down, and sideways, and what the market consists of are candlesticks. All you're seeing are candlesticks on this chart. And what candlesticks are basically the
Hey, bro,
orders.
look, hold on, bro. Look, check this out. How can I
So
record this? Is there any way I can record this?
I'm recording it, but you should be taking notes.
Yeah, I'm taking notes, but I'm trying to record the visual. I got my notepad. I'm trying to
You know
record the
what?
visual.
I can let you record it. Hold on.
I'm trying to screen record, but I don't know
You
how to.
should be able to already. Make host, put in the waiting room, start to access start video. You should be able to record. I'm recording anyway, so I'll just, give it to you anyway.
All right, cool. Yeah, I'm taking
So,
notes though, bro. By all means.
all right.
Yeah, go ahead.
So, the market is nothing but candlesticks. Literally every candlesticks and different intervals, time intervals. So, for instance, in fact, let me go to a different chart because I don't want to mark up that chart.
So the candlesticks represent time intervals.
Right, hold on. I'm gonna explain it. I'm just gonna get all this shit off the market. So, you have time intervals, right? And you see these are the time intervals right here. Monthly, weekly, daily, 1 hour, and this is the way that you can look at the market. Understanding the market is nothing but fractal increments of this bigger time frame. So, if I was to click on the monthly chart, right, this one candlestick that we're looking at represents the month of November.
Cause
You understand that?
you're on the monthly chart.
Because I'm on a monthly chart. So that means this candlestick represents the month of November, and it takes a month for this candlestick to form. Look at this one. You see at the bottom where it says October?
Yeah.
That is a representation that this candle was formed in the month of October because we're looking at the monthly chart. So it took 1 month for one of these candles to form.
Okay.
Right?
Okay.
So same thing with September, same thing with August. You can just look and see that, all the candles, represent a month because I'm on the monthly time frame. So same thing. If I was to go down to the weekly, matter of fact, before I do that, look at this, right? Look at this. And this is basically how you realize how you can see the market if you understand that everything is just a smaller portion, a fractal of a bigger time frame.
I was
So
waiting for you to say that. A fractal.
a fractal means just a portion, just a smaller, like a smaller detail in it, like a smaller detail, basically.
All right.
So a fractal just means just like if you're going into detail. So it's just like a smaller detail into this one candle.
Okay.
So you see how I highlight that one candle, right?
Mm-hmm.
So if I go down to the weekly, it's going to give me is going to give me the weeks of, because I want to do
that month
yeah.
and show you how it was moving each week versus.
So that's in the week, right? Those 4 candlesticks represent the month of October. Go
Okay.
back, you can see it. You can see the yellow. Basically, the yellow is basically that right there. Let me make it a little bigger.
That's the range in which it was moving and shit.
You see it?
Yeah, okay.
Right. So in
And
that month, these are the 4 candlesticks that were formed in that month, which which are moving sideways. You can clearly see that the market is moving sideways. So going down even further, you can see the daily candlesticks. So it takes 1 day for this candlestick to form.
okay.
From October 1st to October 30th. And this is that this is the days of the month, basically. Every single day of the month formed 1 candlestick. That makes sense?
Yeah. Cause this is like you just went deeper and deeper from the month to the week to the
Exactly.
day.
Right. And look, it breaks down even more. 4 hour, right? 4 hour gives me the same thing within, that month. This is a 4-hour chart. That means every single candle represents 4 hours. So it just gives me more definition of what's really going on inside the bigger candle. So it's just like you going into depth, like you're diving into a deeper candle every time. Like, okay, I'm starting at the monthly. I'm diving into the monthly. I'm going to the weekly. Diving into the weekly. I'm going to go into the daily. You know what I'm saying? And it just
Yeah,
goes on smaller and smaller. It just shows you smaller increments of the bigger candle.
I got you. It's like breaking that shit down to like a molecular level. You know.
Exactly. It's called, yeah, and it's all fractal. That's what it means, fractal. That's what fractal is. Breaking down to a fractal level is just breaking it down to a smaller portion of what's really going on. So you understand that, that the overall market is going to be based off the monthly time frame, because the monthly time frame is the biggest time frame. So wouldn't it make sense for things to play off the monthly time frame more than it would play off of the 1 minute time frame, because this takes a lot more time to develop. So it makes more sense for this to have more control of the market, because the smart money, the banks they like to play the bigger increments, the bigger time frames anyway.
Mm-hmm.
So no understanding that the bigger time frame is always going to be king. So no matter what you see in this 1 minute time frame, you know what I'm saying, it ain't got nothing really to do with the monthly time frame. Why? Because it's so small of a definition of what's going on. It could be manipulation. It could look like it's going up, but really it's not going up. It's just, trading sideways, you know what I'm saying? Just to put it in the range, if that makes sense. So, understand that these candlesticks are nothing but sells and buys. So the market is nothing but sells and buys in the market. The only way the market can go up and down is from buys and sells. So people have orders that they put in at a specific price level. Say, for instance, you see on the right side where it says 170002 on the right side of the screen.
Yeah, with the plus
So,
sign beside.
so for instance, I can have orders placed here to buy the market up once it hits this price.
Hold on.
Everything is nothing but buy or sell. So either you're on the selling side or you're either on the buying side. And this is how the whole market fluctuates every single day, up and down. Why? Because it's buys and sells.
Yeah. Now, but explain what you said. You said you can at that 17002 you can make
Place an order. So have an order placed there for you to buy the market, to get into the market when it hits that certain price point. And that's a little bit like, that's kind of like the next step. I'm gonna get there, but basically meaning like I have a trade place here. Like I want to get into the market here. And that's basically how we submit trades in order to ride the wave up or ride the wave down, basically. That's how we get into the market. Because it's an order that we have at that certain price.
And you can get in there and you can either go up from there or go down from there.
That's it.
Okay.
Whether it goes up, whether you're buying up and it goes up, that means the market's putting money into your account. Or whether you're buying up and it's going down, that means the market is taking out of your account. That makes sense? At that specific level that you got into the market. So if I got into the market at 1,700 and it's at 1,650, that means I'm down because I brought the market up. I wanted to go up, but it went the opposite direction. That means I'm down.
Hold on. All right. Say that one more time.
So if I'm buying the market up,
yeah,
right? If I have an order at 1,700 and price goes down to 1,650, that means it's going against what I'm predicting. So that means it's in negative. I mean, I'm in drawdown. That means I'm down.
Yeah.
I'm down 50 points of 50 pips of where I want to be. We're going to go into pips and everything, a little later. But, just understanding, the candlesticks first and understanding how the market, what is the market? Because you got to understand what is the market in order to trade the market. So understand the market is nothing but buys and sells and nothing but orders that's placed in the market at certain price points is where, which is how you kind of understand what's really going on. Does that make sense? Because everything's buys and sells, right? So that means the only way to, get into the market is to buy or sell the market. So if you're buying, and somebody else is selling, then, they're losing money, or whether, depends on which direction it's going. It's nothing but the transfer of wealth, bro. It's just like either somebody's getting paid or somebody's going broke. Basically, because nothing but buys and sells. So that means somebody's going against you, or, the wave going with you. They going with you type. Get what I'm saying?
Yeah, if it go with you, get paid. You don't, you lose.
Right. So, understanding that, you got to understand what is a candlestick. And a candlestick is, like I said, the candlesticks break down to the time interval, but the candlesticks are in itself volume in the market of buys and sells. So you have two different type of candlesticks. You have a bullish candlestick and you have a bearish candlestick. Basically, a candlestick going up and a candlestick going down. And what that means is that on a bullish candlestick, so that means price went up, right? So that means price opened at a certain point, traveled up, and closed at a higher point. So for instance, to form this candle, say this candle formed, it opened, like remember I said, like every time interval, like for 1 minute, it would be another candle, right? It'd be another candle, right?
Yeah.
So, they form after each other, right? So that means when the next candle forms, it opens up at a certain price, right? Opens up at a certain price. So say that price is 20, right? It opens up and closes at 30. That means it's a bullish candle. Why? Because in that time frame, whether it's a 1 hour candle, in that 1 hour, price opened up at 20 and closed at 30, leaving a bullish candlestick.
Because it went up.
Because it just went up, because price closed at a higher price
than where it opened up at.
Right? Yeah. So you get that. So the way the candle forms is usually when you get a bullish candlestick, price opens up, travels lower to fake out people, travel back higher, then closes. So say, it opened at 20, went down to 18, traveled up to 22, but closed at 20. That makes sense? I mean, at 30, sorry.
Hold on. I'm trying to put that, I'm trying to record, like write this down because that shit makes sense. All right. Like you said, all right. You can't really see what I'm pointing at, but all right, where it opens at, that where that 20 at, boom. That's where it started. You said they fake out down low like that, like towards that 10. Then they come
push it up
back up
to make a high.
Yeah. And
then they close it.
Then that's the top of the candlestick.
And not the top of the candlestick would be the high.
Oh, all right, yeah. I mean,
where they close that would be the that flat line that makes the candlestick, that makes the two candlesticks.
Yeah.
Like this.
And you can draw it like that, and the top is the wick. Like that has like the wick or something.
Like you can see how it is. Like some of these have wick, some of them don't. But the top of the wick is always going to be the highs. The top of the wicks, top of these wicks are always going to be the highs, right? And the bottom of the wicks are always going to be the lows. It just depends on which candle is that separates the open and the close. Because if it opened up, traded higher, and closes a bullish candle. If it opened up, traded lower, and closed, it's a bearish candle. We can go back to that right quick. So, so you got your bullish candle, right? Your bullish candles opens up 20, might travel down to 18, travel back up to 32, and then close at 30. And that will make your bullish candle. So that means the 20 is the open, right? The 18 would be the low of the candle because it's a bearish candle. So that means it's going up. So that means that is the low. The close, right, is the final price that it closed at. Then the high was at the highest point that it visited. But this is where all your volume is in the candle. This is where most trading went along. Gotcha. The wicks basically means price just traveled up there.
That's
price
like the
traveled
peak.
Up there, but it didn't stay there.
Yeah, it's like a peak point.
Right, it's like a peak, a climax, and like the low is the valley.
Okay.
Right, that's a perfect way to look at it.
All right.
So you understand that, right? And I'm gonna do the bearish right quick so you can understand that, and then I'm gonna reload the meeting because I got 3 minutes on the meeting, so I'm gonna have to see another link because I don't have Zoom Unlimited, but we getting there. All right. So the bearish candlestick. The bearish candlestick. Only thing between the bullish and the bearish is that the open and the closes are opposite.
Yeah.
Why is the opposite? Because price in a bearish candle will open up at 30, travel a little higher, 32, travel down, make a low at 18, then travel back up just to close at 20.
All right. Can you do that again? I was organizing my notes over this junk. I ain't catch that travel you just did. Direction.
Do it again.
Yeah.
So understanding that a bullish candle goes up, right?
Yeah.
Understand a bearish candle goes down. So if you're just using, logic, if it goes down, that means it has to open up at a higher price. So if price opened up at 30, traveled up a little bit, went to 32, but ultimately traveled down. Ultimately traveled down to 18 to come back up to 20 to close at. Right? It's
Gotcha.
just the open and the close. Everything is still a low and a high, right? You still got your lows and your highs of the candle. That's still going to be a low and the highest point, no matter which candle you're looking at. It's still a high and a low, but it's just the open and the closes of the candle are different because this is traveling. This was at 42.22, but it closed at 40, 4100. In this 1 minute, 1 hour time frame that it created this candle. Whether it's 1 hour, whether it's 4 hours, whether it's 2 hours, it don't matter. But it took that amount of time to create this candlestick.
Okay.
So can you tell me what is 5?
All right, hold on. Let me see. Let me grab my shit.
You back before you call me. You call me, I got it.
5.
Yeah. All right.
5 it's a bullish candle.
It's a bullish candlestick.
Yeah, bullish candlestick.
Right? So what is 6?
Is the bearish candlestick.
Okay.
Which is a sell, right? And
Perfect. Right. Which is a sell. Which is a buy. All right. So that means more sellers are in this candle. More buyers are in this candle. Buyers control this candle. Sellers control that candle. Right? What's 7?
The high.
The high. Correct. What's 8?
8 is the okay. 8 on this one. 8 on this one is the open.
Is the open of the candle correct? Because price open, then traded lower on a sell candle, right? What's 9?
9 is the closing.
9 is the close. What's 10?
10 is the low.
Perfect. And what's 1?
That's the low of the bullish candle.
Correct. What's 4?
The high of the bullish candle.
Correct. What's 2?
2 is the open of the bullish candle.
Right. And what's 3?
The close.
That's right, bro. Appreciate that. That's the first step of understanding Forex. Understand the candlestick, understand direction, understanding how the market moves up, down, and sideways. Understand that banks control the markets, right? Now you can really jump into like the next part of the phase, because this is the basics. This is the basics, but once you understand those, you can now read a chart. You can now read a chart. Why? Because this is nothing. This is all the chart is: candlesticks, up and down candlesticks.
I got you. It's just a lot of them.
Just a lot of them.
You can read one. You can read all of them.
Right. If you can. Right. It's just all of them. And the great part about it, if you click on the candlestick, it will give you the number always at the top of the open, high, low, and close in the top left-hand corner, any candlestick that you click on. So it will automatically tell you where price opened at, where it closed at, what was the high, and what was the low of that candle.
Oh, that's that OHL, that OHLC at the top left-hand of the screen.
Exactly. Yes, sir. Because I'm on that one candlestick, and it's telling me everything I need to know, the price of it. And once you can see that, I mean, you don't really have to be good at math to be good at Forex. A lot of people think you're going to be good at Forex. I mean, math. You don't. Because everything's already mathematically, like, done for you. It's just numbers. You just got to look at numbers. And people are scared of numbers. But, you can't go off what you're scared of. You can't just, be scared of something all the time and not face it and like, oh no, I can't do it because it's numbers.
Yeah, I definitely had somebody get like
You know.
somebody get intimidated by that jump when I was doing the binary options. They was it's all these
So
numbers, man, math. Like it ain't no math. It's just numbers, but
it's just
you know,
numbers.
it's numbers you can get familiar with and things you can get familiar with, and it won't be, you know.
Yep. You definitely
Yeah.
understand. So I'm just gonna go break down kind of like time intervals a little bit more, and which ways we want to use them, you know. Uh, so the monthly time frame, you're trying to guess this candle because you're trading inside of this candlestick, right? So you want
And
to
I'm
guess
about
the
to mute my
direction.
side right quick, bro, because this shit loud.
So the direction, just you want to predict the direction of this candle because you're trading inside this candle. So if you see that it is a bullish candle, right? This is a bullish candle that's going up. More than likely, you want to look for buys in this bullish candle. It just makes more sense because the candle is forming bullish. If it was a bearish, then you probably would be looking for sales. Since this is a bullish candlestick, it's more probability, it's a more of a higher probability that you'll get the buy. The buy is going to be better than the sell. All right.
Okay,
We're on the weekly.
why?
Go ahead.
Hold on. I'm saying, all right, why? If it's bullish, okay, I get it. If it's bullish, you're looking for a buy because is that because you figure? No, you said
That's because you're trading
go back
inside
to it.
this candlestick. So the reason why I'm looking for buys in a bullish candlestick on a monthly chart, because the overall directional bias of this candle is going up. So
Oh
it
yeah, I
would make
got you.
more sense to ride it up versus trying to resist. You get a less probability trade selling in this candlestick.
I got you. I kind of was seeing it wrong. Like I thought it was a bearish. I thought it was a bearish candle. So I was wondering why would I be going buying looking for buyers if it's going down. I got you. I got you.
All right. So we see on the weekly time frame, where the market's going, and the market likes to go where the most money is, or imbalances that they leave inside of the market. For instance, you have an imbalance in the market here, and I'm gonna put a square on it. And basically, what an imbalance is nothing but buys or sells in that area. So in this area, it was so many buys in this candle.
Well, like it only went up.
From this price to this price,
Mm-hmm.
it left an imbalance in the market. You see how all these candlesticks trade beside each other, trade into each other, trade into each other. Then you have this one long line where this wick is right here and this wick is right here, and it's just a straight line.
Yeah.
It's an imbalance. And that means they injected the banks. You know who's doing this? The banks injected so much money into the market to whatever they were doing, whatever motion they were making, that it didn't have enough sellers in this area to balance price. So there's no wicks in this area. And basically the algorithm of the market, it has to be buyers and sellers, and just to balance itself out. That's how the market moves, to balance itself out. It moves up and down and sideways. When the banks get into the market, they leave imbalances in the market, and that's where they want to fill this imbalance back in to balance the price out to go higher.
I can say I've seen that before, and when I was trading, when I was doing boundary options, that is something that I was looking for. I didn't know what was happening, but I just shit,
Yeah.
that was something I
So,
would go for because the market would change dramatically.
and
You
that's
know?
why it serves as a resistance point sometimes.
Yeah.
But this is when they create a range in the market. This is when they bring retail sellers into the market because they're pushing market sideways. And what are they doing? They're creating money in the market, and it's called liquidity. So when they trade to this range, right? When they trade in a range like this, they're basically playing price in between two price points, basically. So just bouncing up and down. So it's trading sideways at this point.
Hold on. You talking about up there at that? Okay, I get it.
See, so imagine these two green lines being numbers, a lower number and a higher number. Bouncing price in between the lower number and the higher number. And it creates range. So it's basically creating money in the market. This is retail traders buy and sell the market. We don't trade this. We know the bigger moves come when they break the range. You know what I'm saying? But we understand it is in a range, but this is on a weekly time frame, so we can still, trade inside of a weekly time frame, of course. But understanding that the market is trading sideways, just seeing the structure of it is what I'm trying to point out. It's trading sideways. They're putting retail buyers and sellers in the market
And when
because
you say
price
they
is
put
going
retail
sideways.
buyers and sellers in the market, like what you?
When I say retail buyers, sellers, and sellers and buyers,
Yeah.
retail buyers and sellers are trading off of this resistance line. They think this is a resistance line here. They
Okay.
think this is, they trade this, it is a resistance line, but they trade this resistance line. They trade this resistance line and they keep doing it back and forth, not realizing that, the banks are just going to, push price higher just to drive it lower, or push price lower just to drive it higher.
So it's like they kind of stuck in a margin that they
It's
keeping
kind of
themselves
stuck.
in.
It's the range. Just say range. It's a range. It's like a
Range.
range in the market.
Okay,
It's
range.
like
They keeping themselves in that range.
right. They keeping price in this range. They bouncing price up and down to create money. Why they create money? Because they like to make a lot of money. So
Mm-hmm.
so what's right here is money.
Okay, and that's the top. So okay, from the highest high and the lowest low
Lowest low. Right.
in a sideways motion like that
It's a range.
is a range.
Mm-hmm.
Okay.
That means they create money up and down sideways. And this is a perfect explanation of it. Right here. This is what I just showed you, right?
Hold on, let me.
What they do is push market up, down, sideways. So every time retail sellers see this line, retail buyers see this line, see that line, it hits the line, they'll buy off it. They're buying here. Every time
Okay.
it hits it again, they're buying here. Right? And this is what it's doing, is creating money underneath their position. So this is position here. Oops. This is their position, right? The line. So
Mm-hmm.
under that they have stop losses. Right? The stop loss there and the stop loss there is stop. So that's basically where they're going drawdown, right? And then hit their stop loss. And the stop loss is basically takes you out of the market because it's going against the direction that you said. Because they brought here, but it's going the opposite direction. So that means they're losing money. right?
Hold on. All right.
So they're doing
Hold
the
on.
same
You,
thing.
you said they bought where and they bought where?
They're buying at this line. They're
At the
buying
top
at
line?
this. They're buying at this line.
The line
Every
on the
time.
top?
No,
At the
I'm
bottom?
highlighting it.
Oh, I got you. Okay.
Let me just take all this off so you can see. So every time it hits this line, they'll sell it. Bam. They'll sell it. Bam. Right?
Okay.
So above it, just imagine above it in this area is money. Why? Because it's stop losses sitting right there.
Okay.
And a stop loss takes you out of the market. So it's basically just money created when every time they're selling it, more people are getting into the market, basically in that range. More people are getting into the market, more people. So it's creating a lot of money on top and on bottom.
Okay.
So what that's exactly what they're doing here. Then they buy the market to take out all the money, to take out this money just to sell it down, to take out that money. And they do the same thing, right? They'll sell it down to take out this money, to buy it up, to take out this money.
Get that money. Okay.
Because it's stop losses sitting down here. And stop losses is money, and that's basically called liquidity.
And right now we talking about what the banks be doing.
What the banks do. So understanding what the banks, you got to understand how they think if we want to move like them, right? You got to understand what they do, what they like to do, how they like to move. We want to trade with them, right?
Yeah.
So that's why we have to understand when they're in the market, identify where they're in the market, understanding what they do when they're in the market.
Mm-hmm.
If you think like a shark, you'll be a shark.
For sure.
And that's all they do. And that's when they buy this market up, right, to buy it back, to sell it, to take out everybody's money, they always sell at the highest point.
Mm-hmm.
Right? But this candle, this blue candle, is where they brought the market, right? It was a buy. So this is called the institutional candle. I don't know if I'm spelling that right.
It's all
But
good.
institutional, I think I did wrong. Anyways, institutional candle. So we understand this is the institutional candle because that is where they brought the market. So we know the banks are here. Like, the banks are here. Why? Because that candle took out all the money that was sitting over here. Just to trade lower.
Over there. All across there.
Just to trade higher.
Right over there.
So he took all the money that was sitting right here.
That ways, right? Okay.
They took that money, right? Right? To go down, to take the money that was sitting down here.
Okay. Because people had they stop losses down there.
Right. Because retail traders sold the market. Oh shit. Sold the market. They sold the market. Wait, I can do this easier. There we go. Sold the market. Come on, bro. It's like stuck. I'm struggling.
You good, bro? Cause I'm still trying to like.
All right, there we go.
All right, I figured that's what you going to that peak over there.
Yeah.
Over
They sold the market there.
over there, okay.
Because that's the last point they was gonna sell at. They tricked them out. They tricked them out, then pushed it higher right here. And that's where the banks are, the yellow candle.
Mm-hmm.
Right? Sold the market. Then everybody that was over here, they took all that money that was sitting over here. Right? Just to trade higher. They took that money. Just to push it higher.
Okay.
To take more money. And this is more money up sitting up here above these highs.
Going across there. Yeah.
Above these highs.
Okay.
Right? So, they just create money. It's everything they just create money, but it's also in a range. It's also still in it's ranges inside of a range, and you just realize where the range is. Like this is another range that is trading in. It's another range. So, this would be if we just looking at the range, it's a little bit more advanced, but we'll get there. But Fibonacci retracement basically bounces off these levels. Measure from the high to the low. You can understand what levels price will play off of. So understand your buying opportunities and your selling opportunities using the fib is a way you can, identify the market too, bouncing off certain levels. So basically everything above the 50% zone is discount price. So think of this range. Think of this range like in two boxes. Like you have 50% in the box, right? You have the higher portion, 50%, and you have the lower portion, 50%. Right? So if you're thinking about a range, where would you want to buy something at a high price, or would you want to buy it at low price?
Low price.
Buy it at the lowest price. So, in this instance, we're selling. So we want to sell at the highest price because we want to sell at premium price. So these levels, understand every time it goes up, it could get a retracement off of these levels, which is at a good premium price to sell at because it's inside of this range. So if it was vice versa, right? If we're looking for buys, you can see how the market bounced off of the 88, around the 78 and the 88 right here, right at this discount price. to go higher.
Okay, hold on. Okay, and that's still in the same. Oh, that's still in the same.
Because it's in a range.
It's in the
Yeah,
range.
it's in a range.
It's in the range. Okay.
Yep, it's still in the range. So it's just like, where are you selling or buying at in that range? Like it wouldn't make sense to buy in this up here, would it? Like, wouldn't it make more sense to buy here, right, in the range, than buying up here in the range because it's already at a premium price.
It's
You're getting
already
it for a
up
high
there.
price.
Yeah. Okay.
You know, think about it like, you can, put it in any term that, works best to, whatever works in your instance, like you buy anything at a premium price. You know, are you gonna sell it at a premium price? Got to at that point. But if you get a discounted price, you could sell it for whatever you want to sell it for. You know what I'm saying? So if you get it at this discounted price, you would have rode this wave all the way up here, which I did catch this low here. I did catch this low. If I would have still been holding this low, man, that would have been crazy. But understand the range, understanding buying and selling at premium prices.
Okay, yeah, because the lower you catch it, the higher you can ride it. If you catch it
Right.
all the way up there in the top end, you ain't got but so far to go.
It's a bigger probability.
Mm-hmm. Premium. Okay. How many pens on? All right, premium. Come on, girl. You got another pen? I just put that pen and dried up. What the hell that happened? Hold on, bro. I gotta grab me another pen now. The first time using this bitch. All right. Premium discount. And you want to always get in the discount. In the discount area, right?
If you're looking for buys, yes, you don't want to get it. You always want to get in for discount. You're looking for sales, you always want to get in at the premium.
Okay. Yeah.
So this would be reversed. So
Discount. You selling?
you sell it premium.
Okay. Selling. Buying.
So this area here, this area would be a nice price sell off of, because you see what level it is. You see it's at a nice discount, a nice premium level of 78. 88 is like the best premium you can get, right? But the 78, if you're just looking at levels, if this is the 100% and this is the 0, I mean, of this level, this is the 50%, this is the 61, 71. These are levels price like to play off of. This is like the Fibonacci retracement. We'll get into that a little later. This Fibonacci retracement.
All right, look. Before I get confused, right? You said when you're selling, when you're trying to sell, you would buy in the
Buying a discount, selling the premium.
Yeah. And when you're trying to when you buying, you would go in at the discount instead of the. Hold on. Is I'm saying it right?
Yeah, you're buying in discount.
Oh yeah, you would buy at a discount too and sell at the premium.
Sell
And
at
then
premium.
when you selling, you'll do the same thing.
I mean, well, it's just selling is premium, so it's just 1 and 1. Like, I mean, it's just opposite basically. If that's what you're saying, yeah, they're opposite.
Okay.
Vice
All right.
versa, you know, you would buy at discount and sell at premium. That's the vice versa.
All right. So I would buy at discount and sell at premium.
Yep.
And if I was selling,
You sell at premium. Sell at premium, buy at discount. That's it.
all right, both ways. Both ways the same thing.
I mean, yeah, buy at premium. I mean, sell at premium,
Buy
buy
at
at
discount,
discount.
sell at premium. All right, yeah, just like in real life with anything else. Buy at
Right,
discount.
just like real life, anything else. Yeah,
Yes.
I think it's a good point to end for real. You understand the range, understand candlesticks, you understand, you know, the market, how the market moves, who's controlling the market, how the market moves up, down candlesticks, you know, when the banks get into the market, you know, you're understanding pretty much everything. So I hope that's a basic general, you know, video that worked.